All right, welcome to our explainer. Today, we are diving into a really wild economic idea, a thought experiment that's designed to prevent financial crises by, and you heard that right, creating them on purpose. It's a total head scratcher. I know what you're thinking. That sounds completely bonkers, doesn't it? Why in the world would anyone want to deliberately make a good loan, one that's being paid on time, fail? Well, stick with me because the logic behind this is honestly what makes it so fascinating. So, before we get into the why of it all, we really need to understand the what and the how. What exactly is this system we're talking about? Okay, so it's called the default lottery. Here's the core idea. The government sets a target, a minimum number of loans that have to default each year. Now, if the economy is doing great and not enough loans are failing on their own to meet that target, a lottery is held, and the winners, or maybe the losers, it kind of depends on how you look at it, are picked completely at random from a pool of perfectly good performing loans. And this lottery creates two totally different outcomes. For the lender, well, it's a straight-up loss. They have to write off a loan they thought was golden. But for the borrower, wow, it's like hitting the jackpot. Their debt is just gone, wiped out. And because it was totally random, it doesn't even hurt their credit score. A really bizarre but pretty powerful outcome, right? Which, of course, brings us right back to that big question. Why on earth would any sane economic system be built around deliberately creating losses like this? Well, the answer is actually found in a pretty famous paradox about what causes financial meltdowns in the first place. And that paradox is all wrapped up in something called the Minsky Cycle. The economist Hyman Minsky had this big idea that long stretches of good times, of stability, are actually what make the system unstable. Think about it. We all get comfortable, credit gets really cheap, and everybody, lenders and borrowers, starts to underestimate risk. Debt just piles up and up until we hit what he called a Minsky moment. That's when the bubble bursts and the whole thing comes crashing down. Now, the psychological engine driving this whole cycle is something called recency bias. It's human nature, really. Because things have been good recently, our brains just assume they'll stay good forever. You know, we put that fancy new TV on the credit card because, hey, we haven't been laid off in 10 years, things are great. We completely forget that risk is always there, kind of lurking just beneath the surface. So how do you fight a psychological bias that's basically hardwired into us and leads to these massive financial crashes? Well, the default lottery has a truly radical solution. You make risk a constant, unavoidable part of the system all the time. So the thinking is, this would have three major benefits. First, it kills that recency bias, right? There's always a chance your loan could fail, no matter how great the economy is. Second, lenders are forced to actually price this constant risk into their loans, which would probably discourage the most speculative borrowing. And third, it aims to create what's called symmetric finance. Let's break that down, because it's a big one. In our system right now, the gains from a big economic boom are private. You know, bank profits, consumer spending. But the losses when it all crashes? Those often get socialized. We all pay for it through bailouts and recessions. This lottery system, though, it tries to make both the gains and the losses continuous and private. The source material uses a great analogy. It's like preventing a massive financial wildfire by setting small, controlled burns every single year.
But of course, there is a reason this is just a thought experiment. You can't just impose this kind of stability tax on the whole economy without some enormous costs and really serious challenges.
Yeah. This is no free lunch. For one, credit could get so expensive that it chokes off innovation and growth. Then you have the bureaucracy. I mean, imagine the massive, complex system you'd need to run this lottery fairly. And then there are the weird behavioral effects. Would people start taking on tons of debt, hoping to win the lottery? Would big money just flee to other countries that don't have this lottery tax? These are huge problems. But the thought experiment doesn't just stop with mortgages and credit cards. It gets even more radical when you apply the exact same logic to the very bedrock of the entire global financial system, government debt. I just love this quote from the source material because it nails it. Applying this idea to government bonds, that is the ultimate heart mode for this theory. This is where it gets really wild. So what's the proposal? A tiny 0.05% annual chance that any government bond could randomly default. Now, that number sounds microscopic, right? But it would have monumental consequences because it would signal the end of the so-called risk-free asset that underpins everything. The shock waves would be felt everywhere. That risk-free rate would suddenly become a minimum risk rate, hopefully forcing governments to be more disciplined with their spending.
The entire banking system, which uses these bonds as supposedly perfect, safe collateral, would face a massive shock. The idea is that this could actually break the doom loop, where a government's financial problems can drag its banks down and vice versa.
So, when you boil it all down, the default lottery, whether you're talking about consumer loans or government bonds, presents us with one ultimate massive trade-off. And the trade-offs here are absolutely immense. Central banks would lose one of their cleanest tools for setting monetary policy. The system would basically act as a stealth wealth tax on anyone holding bonds, while giving debt forgiveness to the public, and it could even threaten the US dollar's status as the world's reserve currency if a ton of capital flees, searching for that illusion of perfect safety somewhere else.
And all of this leaves us with one final, really powerful question. Is it better to pay a small, constant, nagging price to maintain stability? Or is it better to enjoy the wild booms and just risk an occasional, absolutely devastating collapse? The default lottery forces us to confront this idea that stability isn't free. And it really makes you wonder, what price are we actually willing to pay for it?